The Iraqi Dinar today latest news. Imagine, for a moment, the atmosphere inside global financial institutions as a massive, almost unprecedented, operational shift begins to take place. We're talking about a scenario where banks across continents suddenly move with a synchronized intensity, not for a routine update, but to activate specialized, large-scale exchange systems designed specifically for one currency, the Iraqi Dinar. This isn't a small adjustment, it's a full-scale recalibration of digital infrastructure, the setting up of high-security desks, and the implementation of new verification protocols. Analysts have long speculated on what the world would look like if major banks genuinely began preparing for a dramatic surge in dinar exchanges. Today, we're diving deep into that scenario, breaking down the mechanics, the security steps, and the required preparation that would have to occur behind the scenes if this internal preparation ever moved toward a public rollout. Stay with us, because this analysis will provide critical context on the sheer complexity of managing an emerging market currency on a global scale. The foundation of this scenario rests on Iraq's ongoing economic reforms, its crucial oil-driven revenue strategies, and significant stabilization efforts, all of which have been under the microscope of international analysts for years. While no major bank has officially confirmed any immediate, sudden currency revaluation, the conversation among experts frequently turns to the massive logistical challenge of preparing for a high-volume dinar processing event. This kind of systemic restructuring would be an overwhelming undertaking, requiring far more than a simple patch to existing software. It would encompass extensive digital onboarding, a complete overhaul of compliance frameworks, the introduction of sophisticated enhanced monitoring systems, and the meticulous development of high-security verification workflows. Such a move signifies a banking system preparing for unprecedented demand. The systems that would need to be put in place are designed to manage an extremely large number of customers while simultaneously maintaining the strictest anti-fraud and anti-money laundering controls. For banks to successfully scale an operation of this magnitude, the process wouldn't be completed overnight. It would demand months, or potentially even years, of rigorous back-end testing, coupled with intricate cross-border communication and coordination with international regulatory authorities. Our current analysis focuses on what these complex preparations would look like away from the public eye. Understanding why banks would invest so heavily in security, transparency, and compliance if they anticipate a significant and sustained increase in exchange demand is key. This level of preparation highlights just how monumentally complex and globally coordinated currency operations truly are. If major financial institutions were to activate these new, large-scale systems for processing the Iraqi dinar, their single most pressing concern would immediately be verification. It's a well-documented fact that counterfeit dinar notes have circulated in various regions over time, making absolute authentication a non-negotiable priority. Banks would be forced to deploy the very latest updated scanners, advanced ultraviolet detection processes, and access centralized serial number databases. They would also require sophisticated verification algorithms capable of cross-checking physical notes against archived digital signatures. The effort to secure the exchange process would be relentless and comprehensive. Furthermore, banks would need equally robust digital systems to securely verify electronic holdings of the currency, which are typically stored through various online platforms and institutions. This necessitates an exceptional level of collaboration between the Central Bank of Iraq, its various regional bank branches, and international compliance units across the globe. The goal is to ensure that every individual presenting their currency, regardless of whether it's in physical cash form or held digitally, possesses valid, legitimate documentation. In a high-volume exchange scenario, banks cannot afford to rely on outdated manual methods. Instead, They would develop fast processing systems engineered to authenticate large stacks of notes in a matter of seconds. This type of systemic preparation is the clearest indicator of a banking sector anticipating a major surge in dinar-related transactions. Beyond verification, the other major component in a heightened dinar processing scenario is absolute security. Whenever high-value financial operations garner public attention, it inevitably triggers a rise in sophisticated cyber threats, organized fraud attempts, and the emergence of unauthorized broker schemes. Banks would respond to this risk landscape by exponentially strengthening their digital firewalls, conducting extensive and continuous stress tests on all systems, heavily encrypting all transfer routes, and implementing mandatory multi-level authentication procedures for every single customer interaction. These proactive measures serve to protect both the bank and its clients from financial exposure and risk. Every transaction would be meticulously recorded, verified, and traceable through the system. Simultaneously, banks would likely initiate internal audits across all departments to proactively identify and immediately reinforce any potential weaknesses or vulnerable areas within their security infrastructure. They would also have to upgrade their entire appointment software suite, specifically preparing for a scenario where hundreds of thousands, potentially millions, of holders attempt to schedule branch visits within an extremely condensed timeframe. This investment in time, capital, and advanced infrastructure demonstrates the gravity with which banks approach large-scale currency operations. Even purely hypothetical scenarios like this are used to rigorously test institutional resilience and refine systems that will inevitably be utilized for multiple currencies, far beyond just the dinar. To ensure clarity, it's vital to understand a fundamental principle of global banking. Banks do not activate massive exchange systems without explicit regulatory approval. Any scenario involving high-volume currency processing would be subjected to intense oversight from specialized financial authorities, rigorous risk assessment teams, and multiple legal departments. The overarching goal of this oversight is to guarantee absolute compliance with global international finance laws, strict anti-money laundering regulations, and complex cross-border transaction guidelines. Even in a hypothetical situation, banks would remain paralyzed without the official green light from these regulatory bodies, underscoring the legal constraints and requirements involved. The regulatory approval process is multifaceted, including a meticulous review of the proposed exchange rate frameworks, a detailed examination of the bank's total risk exposure, and a comprehensive analysis of the potential scale of transactions. If banks genuinely anticipated a dramatically heightened interest in a currency, they would engage in close, constant coordination with financial watchdogs to design a system that is transparent, safe, and fully documented at every step. This episode explores precisely how this preparation functions, why it necessitates significant time, and how this regulatory involvement is the ultimate assurance of customer safety. Understanding this regulatory process makes it clear how secure and complex global currency management must be, even long before any physical exchange counter opens to the public. If major global banks were to indeed accelerate the development of large-scale Iraqi Dinar exchange systems, one of their most immediate and crucial preparations would involve staffing. They would need a workforce far larger and more highly trained than usual to manage a huge influx of customers within a short window. This would likely start with reassigning experienced personnel from less critical departments, quickly hiring additional temporary analysts, and dedicating significant resources to training customer service representatives specifically on dinar-related procedures. This training would cover everything from authenticating notes and managing appointment queues to handling sensitive customer identification and processing electronic verification forms while recording every single step according to compliance mandates. The staffing model would also require experienced managers who can oversee vast multi-branch coordination, ensuring that every single location adheres to the exact same standardized guidelines and procedures. Additionally, banks might form specialized task forces dedicated solely to monitoring the moment-to-moment flow of transactions. These teams would proactively look for bottlenecks, verification challenges, and system errors, making sure the entire operation moves efficiently, smoothly, and safely. Preparing a highly trained staff team for high-volume currency operations is not an instantaneous process. It demands extensive planning, clear communication, and deep technical understanding. In a scenario where dinar interest suddenly escalates, banks would activate this comprehensive staffing model to ensure every customer receives accurate guidance and a secure, standardized experience. Immediately following staffing, the next pivotal factor would be the implementation of sophisticated digital appointment systems. In a demand spike situation, relying on walk-ins is simply not feasible. Banks would be compelled to build or significantly expand online platforms that allow customers to schedule appointments only through verified accounts. These systems would need the capability to securely authenticate identification documents, check digital signatures, and assign time slots in a way that completely prevents overcrowding at physical branches. Automated notifications would also be critical, reminding customers of their time slots, verifying the exact documents they need to bring, and detailing where to go and what they should expect upon arrival. Furthermore, banks would run rigorous internal simulations and stress tests on these platforms to guarantee they can handle massive volumes of traffic simultaneously. If interest surged, tens of thousands of people might attempt to log in during the very first hour, making platform stability the absolute highest priority. Crucial features would include mandatory two-factor authentication, highly encrypted messaging channels, and a series of digital verification steps. This high-level security ensures that individuals entering the exchange system are genuine holders and not malicious actors attempting to exploit the process. A robust, seamless appointment system is the backbone of any successful, large-scale financial operation, and banks would invest heavily to make it reliable and secure well before activation. A hypothetical surge in dinar exchange activity would also force banks to dramatically strengthen their internal communication networks. In an event of this magnitude, no single branch can operate in isolation. Regional managers would need to maintain constant, real-time communication with the central headquarters, compliance officers, digital administrators, and security units. Banks would utilize highly encrypted internal messaging channels and deploy rapid response communication teams whose sole job is to monitor real-time updates. These teams would share instantaneous information on customer volume, any emerging verification challenges, system errors, or unexpected complications. This crucial real-time coordination enables banks to adjust policies instantly, reroute overflow customers, or temporarily redirect appointments to locations with higher processing capacity. Moreover, bank management would rely on internal dashboards that provide a comprehensive view of overall transaction numbers, pending verifications, and most importantly, dynamic risk level indicators. These centralized dashboards help managers to quickly identify patterns, such as sudden increases in suspected counterfeit attempts or overload at specific appointment centers. The stronger the internal communication, the smoother and safer the operation. When banks prepare for large-scale financial events, regardless of the currency involved, they treat internal communication as one of the most important safeguards for stability and consistency. Without it, confusion would spread quickly, potentially disrupting the entire flow. With it, every step becomes more predictable, efficient, and secure for all involved. The next critical area we examine is technology resilience. In a scenario where banks anticipate unusually high exchange activity, they must ensure their digital systems can absorb and handle sharp, sustained spikes in demand. This applies to both the complex internal software and the customer-facing platforms. Banks would begin by performing intensive load tests on their servers, precisely determining the maximum number of simultaneous users the system can handle before performance degrades. They would also run large-scale simulations involving massive financial transfers, verifying that their processing algorithms can manage the increased volume without crashing. Banks often upgrade their systems in clusters, meaning they strategically add extra backup servers to ensure that platforms remain running even if a primary server fails. They might also leverage cloud-based extensions that automatically increase system capacity when real-time traffic levels rise. These systems must maintain 24/7 stability and activity throughout the duration of the high-volume event. In addition to capacity upgrades, banks would introduce sophisticated monitoring tools that are programmed to instantly detect unusual activity, such as system access attempts from unauthorized regions, sudden spikes in login failures, or suspicious data transfers. Maintaining resilience in digital systems is perhaps the single biggest technological challenge during any large-scale financial operation. If a bank's system were to freeze or malfunction during a peak demand period, the consequences for millions of customers could be severe, which is why resilience planning is completed long before activation. Another essential topic in any large-scale scenario is public communication. Banks understand that unclear or inconsistent messaging can quickly lead to widespread confusion and panic. If a situation arises where interest in the Iraqi dinar grows rapidly, banks would need to issue clear, authoritative public statements outlining precisely what processes are active, what systems are available, and exactly what customers should expect. These messages would be prominently featured on official bank websites, secure banking applications, and verified communication channels. Banks might also establish dedicated customer hotlines specifically to address questions regarding required documentation, appointment procedures, and verification steps. Public messaging would place a heavy emphasis on safety, actively encouraging customers to avoid unauthorized brokers, unverified websites, or individuals making claims of early or exclusive access. Clear communication is the most effective way to prevent misinformation from spreading and to instill customer confidence in the official, established process. It also significantly reduces the workload on branch staff by ensuring customers understand the required steps before they physically arrive at a location. Whether banks are managing a major currency event, a surge in loan applications, or major shifts in global markets, communication serves as one of the fundamental pillars that supports stability. When customers are fully informed and know what to expect, they are more likely to remain patient, prepared, and confident in the process. As we continue this in-depth report, another critical element comes into sharp focus: compliance, internal audits, and rigorous legal oversight. Whenever banks prepare for a high-volume event, every single action must be fully documented to comply with domestic and international financial law. Compliance officers would evaluate every step, from currency authentication to the final fund transfer, ensuring adherence to both national and global standards. Internal audits would likely be performed continuously throughout the event, reviewing transactions in real time to confirm that all procedures were correctly followed. If any irregularities are detected, auditors would investigate immediately, preventing potential risks from escalating into major problems. Legal teams would also play a crucial, pervasive role. They would meticulously review all public communications, every internal process change, all third-party partnerships, and every single digital system update. Banks cannot afford the risk of violating any regulations, as the penalties can be severe and far-reaching. In a hypothetical scenario involving heightened dinar exchange activity, legal departments would ensure that every action strictly aligns with currency exchange laws, customer protection standards, anti-money laundering rules, and data privacy regulations. The presence of strong compliance systems provides customers with the confidence that every step of the process is protected, transparent, and legally accountable. This is why banks never activate major financial operations without robust legal oversight guiding the entire way. Another significant factor in our detailed analysis is logistics. Banks would need to design a physical workflow that can manage thousands of customers while maintaining perfect order, safety, and efficiency within their branches. This means setting up clearly defined entry and exit points, designating comfortable and organized waiting areas, installing additional seating capacity, and physically separating the verification desks from the transaction desks. The central objective is to eliminate long queues and prevent overcrowded spaces, which can quickly compromise security and dramatically slow down processing times. Banks might also utilize digital screens to notify customers when their numbered ticket is called. In cases where extremely high demand is anticipated, banks could even dedicate specialized rooms or expanded service areas solely for currency verification and processing. Logistics planning also includes strategically positioning staff members throughout the branch, so that every step of the customer journey, from arrival to final exchange, flows smoothly and logically. Many banks already utilize similar systems for tax season surges or major financial assistance events. But in a hypothetical high-volume dinar scenario, these systems would be scaled exponentially further. Proper logistics prevent frustrating delays, reduce customer stress, and establish a professional, secure environment where customers feel comfortable and confident throughout the entire complex process. A common and important question viewers often ask is, why would banks invest so heavily in these preparations? The answer is rooted in fundamental risk management and prudent long-term planning. Banks proactively prepare for numerous possible scenarios, even those that may never fully materialize, because having robust systems in place protects both the financial institution and its vast customer base. If financial analysts report growing international interest in a particular currency, banks may begin strengthening their infrastructure to preemptively stay ahead of potential demand. This preparation does not serve as a guarantee of any specific outcome, but it ensures they are fully prepared for unexpected or rapid market shifts. Banks also rely on the meticulous study of historical patterns, financial trends, and geopolitical events to anticipate where currency volatility or sudden interest might emerge. Preparing systems in advance is a hallmark of responsible financial management. To expand this further, technology integration is an absolutely essential component when banks prepare for any major event. This involves perfectly linking internal databases, updating every authentication tool, and seamlessly syncing all branch operations with their digital platforms. Banks would conduct a thorough audit of every system that interacts with currency verification, from sophisticated scanners to digital wallets to transaction ledgers. Crucially, these systems must communicate perfectly with one another to prevent delays or inconsistencies. For example, if a customer's identification is verified at one branch, that information must instantly appear in the central database and be accessible to compliance teams if required. This level of seamless integration requires high-end infrastructure. Banks would also update their cybersecurity software, adding monitoring tools that detect unusual patterns, such as repeated attempts to upload fraudulent identification documents. They might also improve real-time dashboards that clearly display exchange volume, system load, verification status, and branch capacity. When all technology systems speak the same language, customers experience smoother service and staff members operate more efficiently. Even a minor delay in one part of the system can cause massive slowdowns when handling large volumes. which is why strong integration is absolutely essential in any scenario involving heightened interest in the Iraqi dinar. Let's explore another important angle: customer documentation. In any large-scale exchange scenario, customers are required to provide accurate and complete documentation to finalize their transactions. Banks would likely require government-issued identification, proof of address, and potentially documentation detailing how the dinar was acquired. This rigorous process helps banks verify that the exchange is entirely legitimate and fully complies with global anti-money laundering laws. Banks may also introduce special forms or digital questionnaires that customers must complete before scheduling their appointment. These forms could inquire about the amount of dinar being exchanged, whether it is physical or digital, and whether all supporting documents are available and ready. In high-volume events, documentation must be complete and verified before the customer arrives at the branch to prevent costly delays. This is why banks heavily emphasize the importance of preparation and organization on the customer's part. When customers arrive with accurate, organized documentation, the verification process becomes significantly faster and smoother for everyone. Conversely, when documentation is incomplete or missing, the process slows down for all parties involved. Understanding the critical role of documentation helps viewers recognize how essential it is to stay informed and meticulously organized during any large-scale financial procedure, whether it relates to a currency exchange or any other significant banking service. Now, let's address the specific procedures for holders with large amounts of currency. In hypothetical high-volume scenarios, banks design and implement specialized procedures for customers exchanging significant quantities. These transactions may require longer verification times, additional layers of documentation, or scheduled appointments directly with senior bank staff. Banks must ensure that larger amounts are subjected to the most thorough authentication and recording procedures to satisfy stringent legal requirements. High-value exchange rooms may be outfitted with secure counting machines, require the presence of dual verification staff, and utilize separate recording systems that meticulously track every single step of the transaction. This superior level of detail protects both the bank and the customer by establishing a clear, defensible audit trail. Banks often assign their most experienced specialists to handle such complex cases because they require advanced knowledge of compliance rules and regulatory mandates. While large holders clearly require more intensive attention, smaller holders remain equally important to the process. Banks aim to create an equitable system where all customers receive access to safe, organized, and professional service. This balanced and fair approach ensures stability and prevents any one group from feeling ignored or unduly delayed in any major banking operation. Protecting fairness, accuracy, and professionalism is considered a core mission in these high-stakes scenarios. Smaller holders also require thoughtful and dedicated planning. Banks understand that not everyone holds large amounts of currency, but every customer deserves access to secure verification and efficient processing. Appointment systems are designed to evenly distribute all customers across available time slots, ensuring that smaller holders can participate without facing excessively long wait times. Banks may also introduce special service windows or rapid processing lines specifically for individuals exchanging small quantities. This measure helps reduce congestion and creates a more efficient overall workflow. Staff members assigned to smaller exchange lanes receive the same rigorous training as those working with larger accounts, ensuring uniform accuracy and safety. In a high-volume scenario, the goal is to proactively prevent bottlenecks. If smaller holders are forced to wait behind complex, large transactions, the entire system becomes inefficient and frustrating. That is precisely why banks design dual-track workflows engineered to move all customers through the system at an appropriate pace. Every customer, regardless of transaction size, must be treated with equal respect and professionalism. The inclusion of clear pathways for smaller holders ensures that the entire operation is perceived as fair, transparent, and accessible, which is crucial for maintaining public confidence and preventing misunderstandings that often arise when people are uncertain of the process. The next important idea is global coordination. If interest in the Iraqi dinar were to dramatically increase across multiple countries, banks would need to communicate and coordinate not only within their own branch networks, but also extensively with international partners. Global coordination is essential for standardizing verification procedures, harmonizing exchange systems, and ensuring consistent compliance requirements across borders. For instance, if a bank in one nation starts seeing significantly higher traffic, they would be expected to notify partner banks immediately to prepare for similar patterns. In some cases, they might share best practices or update complex verification methods to ensure consistency and stability across all participating countries. This international collaboration also plays a vital role in detecting fraudulent patterns more quickly. If a specific series of counterfeit notes were to surface in one country, others would be alerted instantly, preventing further circulation. Global coordination is a critical, often unseen part of modern international banking, and it helps protect customers everywhere. It ensures that regulations remain consistent, technology systems stay compatible, and security procedures remain uniformly strong. This type of high-level cooperation is not unique to the dinar. It applies to all currencies experiencing a period of high movement. By understanding global coordination, viewers gain crucial insight into how interconnected modern banking truly is, and the level of preparedness required to respond to international financial shifts. Now we turn to market psychology. When any currency gains widespread public attention, even hypothetically, public excitement and anticipation can escalate rapidly. Banks are well aware that strong emotions, hope, fear, uncertainty, and anticipation, can significantly influence customer behavior. This is precisely why clear communication, transparency, and organization are paramount. When people lack clear, official information, rumors spread easily, which can create unnecessary stress or foster unrealistic expectations. Banks combat this by providing straightforward, official guidance that helps customers understand the exact process, outlining precise documentation requirements, explaining appointment systems, and clarifying verification steps. By doing this, banks help prevent general uncertainty from spiraling into mass confusion. Market psychology plays a huge role in how people behave during financial events. Some customers may rush to branches, while others may panic if they cannot schedule an appointment immediately. Banks design their systems to reduce this emotional pressure by promoting fairness, clarity, and consistency. When people understand that the system is structured, fair, and secure, they feel calmer and more confident. This stability allows the entire operation to move forward smoothly. Recognizing the profound impact of human psychology helps viewers understand why banks place such a heavy emphasis on clear, consistent communication during any large-scale financial operation. As we move toward the final part of this extended report, it's important to reflect on why hypothetical scenarios like this hold such value. Bank preparation isn't just about trying to predict a specific event. It is fundamentally about building systems that are strong and flexible enough to adapt to whatever the future may bring. Whether heightened interest arises in the Iraqi dinar or any other currency, banks rely on established, time-tested frameworks to remain stable and responsible. These comprehensive frameworks encompass verification, security, compliance, communication, staffing, technology, and customer support. By studying these potential systems, viewers gain a deeper understanding of how global finance truly operates behind the scenes. Even if a large-scale dinar exchange scenario never comes to pass, this detailed analysis shows the extraordinary depth of planning required of financial institutions to prepare for complex situations. These preparations allow banks to respond rapidly and safely to sudden market changes, ensuring that their customers remain protected at all times. The more advanced and comprehensive the preparation, the more stable the overall financial environment becomes. This extended analysis helps viewers appreciate the full scale of planning required to manage global currency movements. Planning that often goes unseen but remains absolutely essential to the safety, efficiency, and fairness of the entire financial ecosystem. Another crucial factor to consider is long-term system evolution. Banks do not invest in temporary, one-off solutions. They invest in infrastructure that can support future, sustained needs. If they enhance their authentication tools for the dinar, those exact same tools can be utilized later for other high-volume currencies. If they upgrade their digital appointment systems, those robust systems can help manage future surges caused by tax seasons, global economic events, or unexpected regional shifts. This means that even when banks prepare for one specific potential scenario, the benefits extend much further and are long-lasting. Financial institutions are constantly seeking ways to make their systems smarter, faster, safer, and more flexible. They analyze past events, learn from customer patterns, and continuously refine their operational strategies. In this sense, hypothetical scenarios actively strengthen overall financial stability. The updated systems, improved workflows, and advanced technologies remain in place long after the initial preparations are completed. This ultimately leads to better service, stronger protection, and more efficient operations across the entire banking landscape. Understanding this long-term system evolution helps customers appreciate the immense effort and investment that goes into making financial services reliable and secure, not just for the immediate situation, but for many years ahead. This institutional perspective underscores the commitment to enduring stability and customer safety. As we close this comprehensive report, it's vital to leave our viewers with a clear, grounded perspective. The scenario explored today, banks rushing to activate massive Iraqi Dinar exchange systems, is presented purely as an analytical breakdown of how financial institutions prepare for large-scale currency demand. The purpose of this episode is not to confirm any real-world event, but to illustrate the depth and complexity of planning required in global finance. Through this analysis, viewers have gained insight into how banks strengthen security, refine workflows, coordinate internationally, enhance technology, train staff, and communicate with the public. These actions reflect responsible preparation and proactive risk management, both of which are essential in a world where financial conditions can change rapidly and without warning. Regardless of what happens with any specific currency, understanding this rigorous process empowers customers to navigate financial environments with confidence and awareness. It serves as a strong reminder that banking operations are far more complex and interconnected than they appear on the surface.